If you can't explain how a 3.7% interest rate affects every pound in your pocket, you need this video. I'm Hamed from Wealth Decoders. The Bank of England just made a decision that will ripple through your savings, your mortgage, and your investments for the rest of 2026. Most people will ignore this. You won't. By the end of this video, you'll know exactly what to do with your savings, your mortgage, and your investments right now. I'm going to show you the specific moves smart money is making while everyone else sleeps. This isn't theory, this is your step-by-step 2026 playbook. And stick around because I'll reveal the one window of opportunity most people are completely missing. Here's the truth. On May 20, 2026, the Monetary Policy Committee voted to hold the base rate at 3.75%. This was a split decision, not unanimous. Some members pushed hard for a cut to 3.5%. Governor Andrew Bailey said inflation persistence remains a concern. But here's the thing, the market was expecting this hold. Swap rates had already priced it in. So why does it still matter to you? Most people don't know how wild this rate journey has been. In the 2021, rates sat at 0.1%. Then the bank hiked aggressively 14 times to hit 5.225% by August 2023. Since then, we've seen gradual cuts from 5.25% down to 4.5%, then 4.25%, and now 3.75%. That's a massive shift. And every single move created winners and losers. The question is, which side are you on? Let's be real. The bank held because inflation is still sticky. CPI came in at 2.6% in March 2026, according to the Office for National Statistics. That's above the 2% target. Services inflation, the one the bank watches most closely, is running even hotter at around 4.7%. Professor Silvana Tenreyro at the London School of Economics has argued that services inflation lags rate changes by 18 to 24 months. Translation: the medicine is working, but it hasn't fully kicked in yet. Here's what changed everything for savers. At 3.75%, your easy access savings accounts are still paying decent returns. Right now, the best accounts offer between 4.5% and 4.9% AER. But listen, banks are already quietly cutting rates. Moneyfacts data from April 2026 shows the average easy access rate has dropped from 3.18% to 2.85% in just 3 months. That trend is accelerating. If you're sitting in a default savings account earning 1%, you're literally losing money to inflation every single day. And nobody tells you this. Cash ISAs are having a moment in 2026. Your ISA allowance is $20,000 and any interest earned is completely tax-free. With the best fixed cash ISAs still paying around 4.3% to 4.6%, that's potentially $920 of tax-free income on a full allowance. Compare that to a taxable savings account where basic rate taxpayers lose 20% of their interest. And coming up, I'll reveal why fixed rate products are about to get way less generous. Imagine this. You lock in a 2-year fixed savings rate at 4.5% today. Markets are pricing in 2 more rate cuts by the end of 2026. If the base rate drops to 3.5%, those fixed savings deals vanish. Gone. Professor Jagjit Chadha, director of the National Institute of Economic and Social Research, said in April 2026 that the bank will likely cut at least once more this year. The window for locking in premium fixed rates is closing fast. Most of you are sleeping on this right now. Here's the truth for mortgage holders. This rate hold is actually good news for you. Why? because 2-year fixed mortgage rates have already been falling in anticipation of future cuts. According to Rightmove's May 2026 mortgage tracker, the average 2-year fix is now 4.27%, down from 4.61% 6 months ago. 5-year fixes are even better, averaging 4.2%. A 2019 study by the Bank of England's own staff found that mortgage rate pass-through takes 6 to 9 months after a base rate change. The best deals appear before the cut, not after. Most people don't know this. Choosing between fixing now or waiting is one of the biggest financial decisions you'll make in 2026. Let me break it down. If you fix at 4% today on a $250,000 mortgage over 25 years, your monthly payment is about £390. If rates drop and you could have got 3.5%, that's on £220 a month. That's a 67 monthly difference, $844 per year. Sounds tempting to wait, right? But here's the risk. If inflation spikes and rates go up, you could be staring at 5% again. That's $461 a month. Can you afford that gamble? Let's be real. If you're on a standard variable rate right now, you're getting crushed. Most SVRs are sitting between 6.5% and 7.5%. That's insane when fixed deals are under 4.5%. On a $200,000 mortgage, the difference between a 7% SVR and a 4% fix is over $400 a month. That's nearly $5,000 a year you're throwing away. According to UK Finance's data, approximately 700,000 UK homeowners are currently on SVRs. If that's you, stop watching this video and call your broker today. Actually, no. Finish the video, then call. Here's where it gets crazy. Lower borrowing costs mean more buyers can afford mortgages. That pushes property demand up. Rightmove reported asking prices hit a new record in April 2026, averaging £379,470 across England and Wales. Professor Christine Sherriff at the Henley Business School, University of Reading, found in her 2024 research that a 1% drop in mortgage rates increases housing demand by roughly 8% within 12 months. We've already had over 1% of cuts since the peak. The housing market is heating up. If you're a first-time buyer waiting for prices to drop, you might be waiting a long time. Nobody tells you this. Rate holds are often better for stocks than actual cuts. Why? Because cuts can signal panic. The economy is weak. A hold signals stability. The FTSE 100 jumped 8.6% on the day of the announcement. A 2023 study by researchers at the Bank for International Settlements found that markets respond more positively to expected hold than to surprise cuts. If you're investing in a stocks and shares or a CPP, this environment is actually a sweet spot. Steady rates plus moderating inflation equals confidence for equities. And coming up, I'll show you where the smart money is flowing right now. Here's what changed everything for investors. With rates likely heading lower, bond prices go up. UK gilts have rallied significantly since October 2023. But the real game changer? Dividend-paying UK stocks. Companies in the FTSE 100 are yielding an average of 3.8% right now. Combine that with capital appreciation in a falling rate environment, and you've got a powerful combo. Global index funds tracking the FTSE All-World are also looking insane right now. If you're not putting money into the market in 2026, you're literally leaving wealth on the table. Most people don't know this about debt in a holding rate environment. Credit card rates are still averaging 24.7% according to Bank of England data. Personal loans average around 7.5%. These rates barely budge when the base rate moves. So while your savings earn 4%, your credit card debt costs you 25%. That's a shocking spread. Every pound you put into savings while carrying high interest debt is a pound that's working against you. Pay off expensive debt first. This is non-negotiable. Here's the truth. Knowing this information is worthless unless you act on it. Step 1. Check every savings account you own and switch to the highest paying option today. Step 2. If your mortgage fix expires in the next 6 months, start shopping now. Step 3. Max out your ISA allowance before rates drop further. Step 4. Crush any debt above 7% interest immediately. Step 5. Set up automatic investments into a global index fund. These 5 steps will put you ahead of 90% of people in the UK. No exaggeration. Imagine this. It's August 2026. The bank cuts to 3.5%. Fixed savings rates have already dropped. The best mortgage deals from today are gone. Property prices have climbed another 3%. You're sitting there thinking, I should have acted when Ahmed told me to. Don't be that person. The markets are forward-looking. By the time a rate cut is announced, the opportunity has already passed. The time to position yourself is right now. Not tomorrow, not next month, now. Let's be real. Every rate decision widens the gap between those who understand money and those who don't. A 2024 report by the Financial Conduct Authority found that 12.9 million UK adults have less than $100 in savings. Meanwhile, financially literate households increased their net worth by an average of 14% during the rate-cutting cycle. Knowledge is wealth. You watching this video puts you in the top tier, but only if you take action on what you've learned today. Here's the shocking truth that ties everything together. The single most powerful principle in personal finance is this: act on information before the crowd does. When the bank holds rates, most people do nothing. They wait, they procrastinate. But the wealthy, they're already repositioning. They locked in savings rates. They secured mortgage deals. They bought assets before prices climbed. The rate announcement isn't the event. Your response to it, that's the event. Be the person who moves first, always. If this video hit different, I need you to do 3 things right now. First, smash that subscribe button and hit the bell. I drop money-changing content every single week. Second, drop a comment telling me, are you fixing your mortgage or waiting? I want to know your strategy. Third, share this with one person who needs to hear it. Knowledge shared is wealth multiplied. I'm Ahmed. I read every single comment. Let's decode wealth together. See you in the next one.